Hello, I'm Hunsley from Livewire Markets and welcome back to the listed series for 2024. Our guest today is Andrew Lockhart, the Managing Partner at Metrics Credit Partners, and we're talking all things private debt. Andrew, great to see you. Thanks for joining us.
Thanks very much for having me.
So, debt as an investment theme, it's a huge universe. So what makes private debt specifically the best proposition in the space?
Look, I think there are probably two key reasons why people choose to invest in private debt. And one's obviously for the protection and the stability of capital that comes through appropriate lending standards, through the covenants, the controls, the taking of security, and the access to private information to monitor and assess risk. The other reason, of course, is it provides an attractive source of income. And so for investors that are investing in private debt, most of them have been exposed to floating rate instruments. So as the base rate has increased in line with the RBA rate rises, the total return for investors has increased. Plus also, through direct origination, a private debt manager can provide access to fee income that's charged to companies. And so that source of return and the way in which it's passed through to investors is pretty attractive.
We'll talk about your two funds in depth a little later, but I'm curious, why did you and the Metrics team choose to offer access to the private debt space in LIT form?
I guess what we look at with all of our various funds is that investors have a different requirement. So the universe of private debt is quite significant. It can be at one end of the spectrum a defensive alternative to traditional fixed income. At the other end of the spectrum, it can be an equity market replacement. And so often when people are thinking about it in the context of their portfolio decisions, they're thinking about, well, what's the return that I can achieve from this asset class? What's the risk profile of the underlying investments that are held in the fund that may generate that return? What's the level of diversification and fees and costs and all of those sorts of things, but also liquidity and access to their capital if circumstances change is a big factor in investment management in terms of how people might access the asset class. And so if you think about private debt, it's predominantly a less liquid asset class. You know, you're lending for maybe 1 year, 3 years or 5 years. And so to be able to give investors access to the asset class, but being able to give them liquidity via trading in secondary markets on the ASX, I think is a very attractive way in which people can gain control over the liquidity risks associated with investing in private debt.
So you and I have actually had conversations about private debt before, and when you and I last spoke in September, I found it interesting that you argued that private debt can still grow at 5 to 6% even in a recession. So what would you say are the asset class's growth projections if, as is now widely predicted, Australia does not go into a recession?
I think it's about the same. You know, demand for credit remains fairly constant. You know, you do see a slowdown in activity and that will obviously impact, you know, borrowers' demand for financing as they slow down their CapEx or projects take longer or are delayed or postponed because of business or economic conditions. That's a reality of a slowing economy. But I guess what I'm really sort of seeing in our market is the continued sort of withdrawal of other market participants and the replacement of sort of private credit providers as being a significant part of the market. And so I see very strong demand for our financing and the provision of capital to a whole range of clients that we provide financing to. So I think growth for us is, in terms of demand, remains very strong. It's really important, right? Because at the end of it, you need to be able to manage a pipeline of origination transactions and opportunities, because otherwise you end up sitting on cash and it becomes a cash drag for investors in terms of their returns. And so it's really important that as a private debt manager, we continue to invest in strong origination capabilities, have a pipeline of good transaction opportunities. Even if business or economic conditions deteriorate, we want to be able to find appropriate lending opportunities to drive the right outcome for our investors.
So in that same vein, what protections, and I guess what specific protections does private debt provide in the event things don't turn out the way you expect them to?
Look, I guess as a lender, what you're always doing is you're forecasting out things that may go wrong. What are the risks that may change the company's ability to generate cash flow to service and repay their debt? What's the project parameters that may change? And so when you look at that, what you're trying to do is obviously ensure that you're not you've built in a buffer for deterioration. And so the way we always look at it is, you know, you want to understand the company that you're lending to or the project that you're financing, a property development project or whatever it is, to ensure that you understand what are the sources of cash flow that can service and repay your debt, and then what are the risks to that assumption, and then ensuring that you've got appropriate equity capital as a buffer and you've got multiple ways in which you can exit your exposure in the event of a deterioration. So all of that comes together to really designed to protect investors' capital.
Okay. Well, when I talk to high yield and private debt investors, I always like to ask them about those three key risks, right? The defaults, maturity walls, and illiquidity. So how do you at Metrics view the current market environment with each of those risks in mind?
Look, I think the market's slowing, right? And so you would expect a slowdown, and obviously with interest rates rising, then businesses and others will be more cautious around how they might undertake growth projects. So I think for us, we're not seeing any systemic issues in terms of our portfolio around increasing in default rates or anything like that. But also, as a private lender, you've got a lot of ways in which you can manage risk. If you get a deterioration in credit quality or a deterioration in business or economic conditions, the asset class and the investor class that should wear that risk of loss is shareholders and equity. And so, as a lender, again, what we're structuring is for transactions to be able to absorb any deterioration in business or economic conditions. And so a default, a non-payment default, is effectively an early warning trigger to a lender to allow you to go in and take proactive action to manage your risk. And so we're not seeing any significant uptick in defaults. We're certainly not experiencing any losses across our portfolio. And so from that perspective, I think our conditions remain strong and pretty attractive for investors to gain access to the market.
So when you work on these originations, when you're trying to scout out these enterprises that you want to provide funds to, the firms that you want to deal with, what, and forgive the pun everybody, what metrics do you look out for as an investor?
Oh, look, you're always looking at what is the stability and predictability around cash flows. So if you think about, one of the things that we like about property development transactions, for instance, is the source of repayment of our debt facility is the eventual sale of the property on completion. So you've got a known source of repayment, and it's more predictable because you can obviously require pre-sales and those sorts of things to be obtained. And so when we think about other industries, if you think about some of the industries that are exposed to, say, commodity prices or production volumes or foreign currency risk, weather, trade disputes between government, the variability of their cash flows can be quite material. And so as a lender, what we're looking for is probably, one, a really deep understanding of the company's strategy and how they intend to be able to drive earnings growth and free cash flow. And a lot of that also comes down to an assessment around management and management's capability to implement their strategy, and then obviously the appropriate capital structure that can support any deterioration in business or economic conditions.
So where are you specifically finding the most opportunity in today's market?
I think for us, we're across the market. So there are some private debt managers that specialise in non-bank or sort of financial sponsor leverage and acquisition finance transactions, or there are others that specialise in real estate transactions. For us, we've taken the view that what we want to do is to be able to offer investors a wide diversification across both corporates and real estate related transactions. And so our origination activities are across the entire market. So we're active in lending for corporates, active in project and infrastructure funding, leverage and acquisition finance, commercial real estate, structured credit, a whole range of areas where we are active in seeking out to originate good quality transactions. And we do that because what we're looking to do is to find the best risk adjusted returns regardless of an industry specification. So our view is that one of the greatest risks that an investor is exposed to in private debt is the risk of a loss in the event of a default, right? And so as a result of that, industry diversification is probably secondary to individual counterparty exposure. So as a lender, what you're looking to do is to have a number of exposures that are small in percentage against your total investment portfolio, because you don't want to have a concentration of risk against any one individual borrower. And so for us, we look across the market, across industries, and more importantly, we look to build long-term relationships with the companies and project participants that we're involved in financing, and we build those relationships with the view that that will deliver good outcomes for our investors.
So are you saying that everything everywhere is rosy?
I wouldn't say that. At the end of it, what you've got is different credit quality, different terms and conditions, and everything is very bespoke. And so, like for instance, you and I could be the same kind of industry, but I might be more levered than you, and therefore the risk profile will be different and the return profile for the investor will be different. But it doesn't mean that either of us are operating bad companies. And so the role is to understand what is the risk profile associated with lending to either company, and to ensure that both companies can support and sustain their operations and implement their strategy to be able to drive cash flow, to be able to service and repay our debt.
Yeah, that's completely understandable. So I did mention that we would come back to this funds question. Obviously, Metrics run the two ASX listed funds. What role do your funds play in an investor's portfolio?
Look, we really set up the Metrics Master Income Trust to be a defensive alternative to traditional fixed income. So it's really designed to be that capital stable, attractive source of income. Monthly income's distributed. We seek to deliver investors a minimum return of the RBA cash rate plus 3.25%. So very much squarely in that defensive portfolio allocation. MOT, or the Metrics Income Opportunities Trust, which is the second ASX listed fund that we operate, was really designed to be an equity market replacement. It's at the other end of the risk spectrum. And so what we're participating in there is senior debt, mezzanine debt, subordinated debt, but also we invest in private equity positions, so minority positions in corporates, and we're involved in a number of real estate equity investments as well. And so what that's designed to do is to give investors an attractive, higher yielding income, but not giving up all of the opportunity to participate in some potential growth in capital if our investments are successful. And so as we built out that fund from April of 2019, a number of equity positions have been held, and like all equity positions, it's not as though you make the investment and it crystallises in a day one gain for you. It takes some time to work on those businesses, work on those assets, and then to exit and realise those gains. And so we're hopeful that and expect that over the next number of years, those early investments will start to bear fruit for investors.
Right, Andrew, some great insights there. Thanks for joining Livewise Listed Series.
Thank you very much, Hans.
And thank you for joining us. If you enjoyed that interview, why don't you subscribe to our YouTube channel, as well as both the Livewire Markets and Market Index websites, where you can also catch the rest of the listed series. Thanks for watching.